Welcome back to SSN Updates. If you receive Social Security, a pension, SSDI, SSI, or any federal benefit deposited directly into your bank account, what I am about to share with you could directly affect whether your payment arrives on time or gets frozen entirely. Starting in 2026, a new federal banking compliance rule is changing the way financial institutions handle accounts that receive recurring government benefit deposits. And here is what you need to hear right now. If your bank cannot verify certain information tied to your account, your direct deposit, including your Social Security check, may be delayed, flagged, or temporarily suspended. This is not a rumor. This is a real regulatory shift that has already begun rolling out, and millions of Americans have no idea it is coming. Today on SSN Updates, we will break down exactly what this rule is, how it works, who is most at risk, what the SSA is telling recipients, and the specific steps you must take before this takes full effect. Stay with us through the entire video. The action steps at the end could save you weeks of financial disruption. What is the new $250 bank rule and where did it come from? Let us start with the basics, because the name of this rule can be confusing. The so-called $250 bank rule refers to a federal compliance threshold tied to enhanced Know Your Customer, or KYC, verification requirements that the Financial Crimes Enforcement Network, known as FinCEN, has been phasing in since 2024. Under this framework, banks and credit unions are now required to apply heightened account monitoring to any account that receives recurring electronic deposits, including Social Security payments, SSI payments, SSDI payments, and pension distributions, when certain verification conditions are not met. Here is what that means in plain terms. If your bank's records do not match the information on file with the Social Security Administration, or if your account has incomplete identity documentation, your financial institution is now required to flag that account. In some cases, especially when the deposited amounts reach or exceed the $250 threshold on a recurring basis, which virtually all Social Security checks do, the bank must either resolve the discrepancy or report the issue to federal regulators. The SSA has officially confirmed that it is working with the Department of Treasury and FinCEN to align beneficiary records with banking data. According to federal announcements from the Treasury Department, this coordination effort is part of a broader push to reduce payment fraud and identity theft, targeting older Americans and disabled recipients. The intent is protective, but the real-world impact for millions of recipients on fixed incomes could be deeply disruptive if they are not prepared. Who is most at risk, and why this hits fixed-income households the hardest, so who needs to worry most? The answer is anyone who receives a federal benefit payment by direct deposit and has not updated their banking information, verified their identity with their financial institution recently, or whose name, address, or Social Security number does not match exactly between their bank account and SSA records. That covers a staggering number of Americans. Consider Dorothy, 74, from Ohio, who has received her Social Security retirement check in the same checking account for 11 years. Her bank recently sent her a letter asking her to verify her identity in person. She ignored it, assuming it was junk mail. Under the new 2026 compliance standards, her account is now flagged, and her next direct deposit could be delayed by up to 30 days while the discrepancy is resolved. Or consider Marcus, 57, from Texas, who receives monthly SSDI payments. He moved apartments 2 years ago and never updated his address with either his bank or the SSA. His bank's records show one address. The SSA has another. Under the new rule, that mismatch is a compliance trigger. The hardest hit populations will be elderly recipients who have had the same bank account for years without updating it, disabled Americans on SSDI or SSI who may face communication or mobility challenges, pension recipients whose employer-managed retirement accounts have been transferred to new banking partners, and low-income households for whom a single delayed payment means choosing between prescription medications and groceries. For these Americans, this check is not discretionary income, it is survival. What the SSA and your bank are now required to do. Here is where it gets serious. Under the new framework, your bank is not simply checking whether you are who you say you are as a one-time formality. They are now required to perform ongoing monitoring of accounts that receive recurring federal benefit deposits. That means even if you passed identity verification when you first opened your account, your bank may be required to re-verify your information based on a change in their internal systems, a data mismatch flagged by Treasury records, or a routine audit cycle. The SSA has officially confirmed that it is sending letters to beneficiaries whose direct deposit records require attention. These letters come from the SSA directly via ssa.gov communications and will ask recipients to either log in to their My Social Security account to confirm their banking information or to call the SSA's toll-free number at 1-800-772-13 to complete verification by phone. According to the latest federal announcements, the SSA is also working alongside the Centers for Medicare and Medicaid Services, CMS, to ensure that Medicare beneficiaries who have Part B premiums automatically deducted from their Social Security checks are not disrupted by banking compliance flags. The concern is real. If a Social Security payment is flagged and delayed, the automatic Part B deduction may also fail, potentially creating a gap in Medicare coverage that the recipient will not even be aware of until they try to use their benefits. Here is what you cannot afford to ignore. A delayed direct deposit for a Social Security recipient is not the same as a delayed paycheck for a working adult. There is no backup payroll system, no emergency wire, and no same-day resolution. The clock is already ticking. What Medicare, SSDI, and SSI recipients must know right now. If you receive Medicare, SSDI, or SSI, your exposure to this rule is actually higher than for standard retirement beneficiaries, and here is why. SSI recipients in particular are subject to strict asset limits, currently $2,000 for individuals and $3,000 for couples. Under the new banking compliance standards, financial institutions may report account activity to verify that SSI recipients are not exceeding these limits. Any discrepancy between reported bank balances and SSA income records could trigger a compliance review that affects both the banking account and the SSI benefit itself. For SSDI recipients, the concern is different but equally serious. SSDI payments are tied to work history and medical eligibility, and any disruption in payment continuity can create complications when recipients are managing medical bills, therapy appointments, and prescription costs. The National Council on Aging, NCOA, has noted that disruptions in SSDI payments disproportionately impact recipients who rely on automatic billing for medical services. Medicare recipients who have their Part B premium of $185 per month, the standard 2025 amount deducted directly from their Social Security check, must be especially vigilant. If your Social Security payment is held or delayed due to a bank compliance flag, your Medicare Part B deduction could fail. While CMS typically offers a grace period, recipients who fall behind on Part B premiums risk losing their Medicare coverage, which could mean full out-of-pocket costs for doctor visits, lab work, and outpatient procedures. For someone managing a chronic condition, that is devastating. Your action plan: steps to take before this takes full effect. I cannot stress this enough. Do not wait until you receive a notification that your payment has been flagged. Act now, while there is still time to resolve any issues before your next deposit cycle. Step 1. Log into your My Social Security account at ssa.gov and confirm that your direct deposit banking information is current and correct. Check that your bank's routing number, account number, and account holder name match exactly what your bank has on file. Even a small discrepancy, a middle initial, a name suffix, an old account number, can trigger a flag. Step 2. Contact your bank directly. Call the customer service number on the back of your debit card and ask whether your account has been flagged for KYC re-verification or identity confirmation. Ask specifically whether your account is in compliance for receiving recurring federal benefit deposits. Many banks will not proactively notify you until a flag has already been placed. Step 3. Update your address with the SSA if you have moved in the last 3 years. You can do this online at ssa.gov by calling 1-800-772-1213 or by visiting your local Social Security office. Missing this deadline could delay your payment by months. Step 4. If you receive SSI, request a benefits verification letter from the SSA to confirm your current payment amount and bank details. This document can also help resolve discrepancies quickly if your account is flagged. Step 5. Contact your State Health Insurance Assistance Program, known as SHIP, if you have concerns about your Medicare Part B premium deductions. SHIP counselors are free and available in every state. Visit Medicare.gov to find your state's program. Step 6. If you need additional help navigating this process, contact the AARP Foundation at 1-877-434-7598. Their benefit access counselors can help you coordinate between your bank and the SSA and ensure your records are aligned. Looking ahead to 2026 and beyond, this banking compliance shift is part of a much larger trend in federal benefit administration. Congress has been pushing for tighter integration between the Social Security Administration's payment systems and financial institution databases for years, largely in response to rising benefit fraud, identity theft targeting seniors, and pressure on the Social Security Trust Fund, which current projections suggest could face a funding shortfall as early as 2033. The future of Social Security depends, in part, on reducing improper payments and fraud. Advocates at the Medicare Rights Center and AARP have acknowledged the necessity of stronger verification while also pushing hard for clear, accessible notifications to recipients before any payment disruption occurs. What this signals for Medicare and Social Security going forward is a system that demands more active participation from recipients, staying current with records, monitoring accounts, and responding promptly to official communications. We will continue tracking every development on this story closely so you never get caught off guard.